Hi, Robert Bonavito here, New Jersey forensic accountant. Today, we're going to talk to a topic that I'm pretty interested in, and it's going to be a lot of fun because it has to do with mortgage fraud. Now, mortgage fraud, we testify in a lot of cases and put people in jail, but usually they're bigger matters where there's hundreds of millions of dollars, false appraisals, that type of stuff, bank issues and fraud. But I'm going to just get into a little into the weeds here and talk about understanding mortgage interest rates because a lot of consumers, a lot of attorneys don't really understand interest rates with mortgages, and that's one of the most important aspects when you buy a house. So this is kind of like a personal type thing we're going to talk about, but the main thing you need to remember when you talk about mortgages is caveat emptor, which means buyer beware. And why this is so important with mortgages is because it's one of the things buyers overlook, especially first-time buyers, because they're so excited. They're worried about the down payment. Is there a problem with the house? Can they afford the house? All these other things. How are they going to decorate the house? How many? All that stuff. But one of the most important things is the financing, because if you can't afford it, all that other stuff doesn't mean anything. So you really need to just understand a little bit about mortgage interest rates. I'm going to go in kind of deep here, but you can always look back at the video and reference it and understand it. You don't have to tell the mortgage brokers that you understand this stuff. Just let them talk, and you'll understand then if what they're saying makes sense. You don't have to debate them, but this is going to give you a good deep background on mortgage rates that a lot of mortgage guys don't even understand this stuff. And the reason they don't, more people buying houses, they don't really take the time to get different quotes and obtain multiple mortgage rates because they're dealing with the bank or the broker. They just get one guy and they just stick with him. They don't check the rates like they should. It makes no sense, right? When you buy a car, do you check other cars? When you buy anything, do you comparison? This is one of the biggest, if not the biggest purchase ever, and you don't check the interest rates on the mortgage. So what happens is many buyers assume that, well, I got a really great FICO rate. They think they're going to get the mortgage broker or banker is going to give them the best rate. That never happens. Okay, you need to ask for the best rate. You need to say, look, this doesn't make sense what you're telling me. I should get this rate. Because why would they take money out of their own pocket when they don't have to? I mean, if they can make, $8,000 off of you in a mortgage, the broker, he's going to do it. I mean, but if you talk to him and discuss it, maybe he'll only make 2,000 or 1,000, something that's fairer. So you need to understand this stuff because you're talking tens of thousands of dollars, if not maybe even $100,000. So how much mortgage? Let's just take a step back. How much can you really afford? Okay, just again, this is just so you understand what you need to do. Now, generally, what you should do as a homeowner, the homeowner's insurance, the property taxes, and the mortgage itself should be about 32% of your monthly income. Now, nowadays, no one does that. Everybody's like 40, 48, 49%. Most bankers won't let you borrow more than that, but the goal should be 32%. It's not realistic in the environment we are in now because houses prices are crazy and people aren't really checking things. So that should be your goal, but banks and mortgage brokers will let you go up to 50% of your income generally. Put down 20%. Now, again, people nowadays, they can't afford it because the houses are so expensive, but at least you have a goal. Because if you put down 20%, you avoid what's called private mortgage insurance. Now, this is not insurance for you. It's insurance for the bank if you don't pay. So it's absolutely useless to you, okay, private mortgage insurance. It costs you $50 to $100 a month. In addition, add it to your mortgage. Get rid of it if you can, okay? This is a goal. Let's see. Now, determine what type of loan you can afford. Now, with rates so low like they are when I'm making this in 2001, 2021, everybody's going to get a fixed rate. It's just a matter if you want a 15, 20, or 30 year. And that's very important because I like 15 years if you can afford it because 15 years goes pretty quick. And even if you stay in a house for 5, you're 1/3 done, where if at 30 you're barely, paying anything down. So we'll take a look at that. Now, how are mortgage rates calculated? And again, here you could see like the 30 and 15 year and the ARMs. And you could see like the rates back in the 80s, they were way up here at 18% when I was buying my houses. my first house. And then they went down, and this is where we are now, way down here. And, so you guys are buying at a good time. But listen, if the rates are lower, they just raise the price of the house. So it's all the same as far as but if rates were 18%, the price of houses would come down so people could afford them, It's based on, like I said, it should be about 32% of your income, and that's it. And if there's not enough people buying the house, they're going to lower the price of the house. So, but here's how you calculate, here's how they calculate what the banks do. They take the 10-year treasury rate and they add 50 to 100 basis points, like 100 basis points, 1%. And that's their profit. That covers their cost of the loan and to advertise and all that kind of stuff. But basically, they use the 10-year rate to calculate that. Now, if you want to see the, let's see. Okay, so here's a website that you can go to and figure out what they should be charging you. So, for example, here, this is again a government website, and here's a 10-year bond, and you can see it averages about, let's say, 1.6. So, if they're going to add let's say 1% to that, I should be able to get a 30-year mortgage for somewhere around 2.5 to 3%. Just a ballpark, and this is, again, something for you to just a little bit deeper. This is what the banks do, and that difference between a 10-year and what they charge you, that's their profit. It covers, not their profit, it covers expenses and all that, but it also is their profit, okay? And again, you want them to have a fair profit, but a lot of these mortgages I see closing, the broker alone is making $8,000 or $9,000 or $10,000 for 2 hours worth of work. So, I mean, this is a tremendous abuse, but at least you can do the calculation in your head. Okay, I looked at the 10-year bond. You guys should be charging me 2.5 to 3% for a 30-year mortgage, and if it's a lot higher, then there's a problem. If it's a lot lower, that's good. So that's kind of where you can figure that out. Now, this kind of gives you, this is it shows you from 2012 to today, the 30-year fixed rate mortgage compared to the 10-year. Now, you can see they kind of trade when the rate on the 10-year goes up, the mortgage on the 30-year fixed goes up. And right now, it's down 1.5, 1.56. You can see that it's down here. So this tells you that what I'm telling you is actually real. And this is, again, from, U.S. economic development. So it's reliable. But don't forget, you need to understand the difference between the annual percentage rate and your mortgage. This is the most important thing you got to take out of this video. If you understand this, the APR versus the mortgage, how they calculate your mortgage interest rate. Now, the interest rate on your loan is the nominal interest rate, is the rate used to calculate your monthly payments. And we're going to go through this so you understand it. The more important rate is the APR. This is the true rate, including all costs, such as broker's fees and all that. So you always want to be comparing APR to APR, right? You don't want to be comparing. Who cares what the interest rate is? No, I don't care. I want to know what the APR is. That includes everything. Now, a good place to check mortgages is this bankrate.com. Now, this is a website that it's a public, it's a business. So you got to be careful when you go to a business. But here, this is bankrate.com, and it's a great place to start. But like I said, you need to be, they'll trick you too, and everything they say is not 100% above board, but the rates are the rates. Now, I put in a price here. I assume we're buying a house for $412,800. We got a 20% down payment, good credit score, and it's a purchase, and we're assuming a 30-year fixed rate. Okay, so this is kind of what we would expect. So here we have the 30-year fixed rate in here, and these are the rates. Now, remember, it says featured lenders here and all results. Guess what? We want all results. We don't want the people that are just paying to be listed. And here's a mortgage company. Okay, they have the rate, which we talked about, and the APR, which I said is really the only thing we care about. These are the upfront costs, which is, we're paying that to get. That's why our APR is so high. That's why it's higher than the fixed rate. So why don't we? And here's the mortgage payment. Why don't we use this one here? Because there's no points, right? We'll use this one. And if we look at a little spreadsheet I have for you guys, I made a little Excel sheet so we could do some calculations here. But here I have the 30-year rate in here, right? Well, this sheet here is, if you want it, I could send it to you, but it kind of gives you some good information. You know, it gives you the price and all this stuff. It tells you the square foot, the price per square foot, the taxes, the insurance, everything's on here. And also I do a little calculation here to check to make sure that the value that how they're selling the house for is appropriate. There's valuation here, which kind of told me I use a $2,000 price and increase it by 2% a year to make sure they're not overpaying for the house. But listen, let's get back to the mortgages here. And this here is telling me that a 30-year mortgage is this, $3,448. The taxes are this, the insurance is this, and the total cost is here. Now, again, this should be what, 32% of your income. Well, that means I should be bringing home $6,400. I should be making about $76,000. Now, so this here, let's see if it agrees. Let's see if my calculation agrees. Yes, it does. Better. We're using 0 points, and the payment's $1,348. My total payment that I care about. But let's say, okay, maybe we want to look at the 15-year or a 20-year, right? Because I have the 20-year and the 15-year. And I did the same exact thing we did here. I went into there and I put the rates in here. And you could see that if I take a 20-year loan, it's, you know, it's about $400 more a month. If I take a 15-year, you know, it's about, you know, it's quite a bit. It's about $700 more. It's a lot. So I would like to see you get a 15-year mortgage because it's nice to have no mortgage when you're like 35 or 40 years old. But it's $750 more about, so I don't know if you could swing that, but at least you know. Now, and you want to be able to, you don't want to rely on the broker. You want to understand this and just talk to him about it. So this gives you lots of good stuff here, right? I have all the information about the house here. I have the different rates. I have this valuation calculation. And, you know, most importantly, I understand the difference between using this site here. I understand the difference between APR and rate, right? What dummy is going to pay $5,674 for a 2.5% rate when, okay, you went 0.25% more, you're paying zero. You could figure it out. It's probably worth it to keep this money. So, but the broker obviously would like this because why? He's making $5,000 more than he is. You know, they're already marking this up. So I gave you a lot to think about here. But at least you're going to be aware. You have all, you can go back in this video and look at everything and figure it out. Hopefully you enjoyed this video. And if you could smash my like sign below, I really appreciate it. If you subscribe to the service, the YouTube channel, I'd like that too. It's great for us. I really appreciate it. And if you have any comments, leave them below. Me or one of my analysts will get back to you. Thanks a lot.